We are continuing in our discussion of zone qualifications, and in this module, we're going to be talking about freshness of the zone. So, when you see the big move, when you saw that it also broke structure, that is, the move either break through a former support point or a former resistance. Now, you've ascertained those ones. The next thing you want to um, see is the freshness of the zone. Okay, so let me quickly explain what that is. Now, like I wrote here, one of the most crucial criterion that will make a difference in trading supply and demand is the freshness of the zone, because it is a key odd that enhances trading supply and demand. Okay, the more the level is tested, the weaker it gets. Now, the more the level is mitigated, when we're talking about freshness of the zone, we're talking about the number of times the zone, either a demand or a supply zone, has been mitigated. In other words, how many times has price come back into that zone, you know, and it simply just moved away. Okay, that is what we're talking about, the freshness of the zone. Has the zone been mitigated before? Has price come into that zone before? That is exactly what we are talking about when we're talking about the freshness of the zone. Okay, all right. Now look at this particular chart here. You can see that, okay, price actually moved to the upside, and price came in, you know, into that particular zone for the first time. Price actually moved very strongly to the upside, and this is your order block or your basing candle, depending on which one you choose to call it. And price moved into that particular zone for the first time. Now, this is the strongest possibility, okay, because the price is just coming into that place for the first time. It is actually the highest probability setup, okay, because price that place is being mitigated for the very first time. Now, look at this again. Look at this, the next one. Here, price actually moved strongly, okay, to the upside in this particular case, okay. All right. And your demand zone is actually the that candle before the big move actually started. Okay, that's your demand zone is or you call it the whole B, that is the order block or your basing candle, for that particular zone. Now it has been marked. Now look at what happened. Price simply came in for the first time, and it went up. Now, this is your first mitigation. This here is your first mitigation. And when price has actually moved up, it has rallied up again. Now, price came back into that particular zone for the second time. This second time is what is actually your second mitigation. Of course, if you see what you need to see, I mean, if the second movement actually, if it satisfies, our our entry protocols, like we're still going to discuss later, of course you can still take it. But once a zone has been mitigated the first and second time, the third time is already weak. Don't take that kind of trade when price is mitigating a particular zone, either a supply zone or a demand zone, for the third time. It is no longer what? It is no longer tradable. When price is mitigating a zone for the third time, it is no longer tradable. So your first mitigation represents the strongest possibility. Okay. The second mitigation, yes, if you see what you need to see in terms of, if it satisfies the entry protocols, fine, you can still take it. But the third time, please simply just look away. It is no longer tradable. All right. So let's quickly look at this freshness of the zone. All right. So now look at this particular nice move, that represents our supply zone. Okay. It's look at what happened just before that. You can see a number of a number of doji, uh small bodied candles before the big move actually started. So certainly we know that this is going to be our what this is going to be our supply zone. So we're going to mark this out as our what? We're going to mark this out as our hold B, our holder block. All right. So when price eventually came back, price that we certainly have to come back to mitigate the rest of the order in that particular zone. All right. So this is the first time, this is the first pullback, and it represents the highest or the strongest possibility for us, to really make money on selling from this particular zone. Okay. These actually, we say that you sell from supply zones, of course, and you buy from demand zones. Okay. So when price is actually going down, that's where you sell. When price is going up, you buy. All right. So when price actually pulled into this particular zone to mitigate it, this is the first mitigation and represents the highest probability. Okay. So let's quickly move on. All right. Now, still looking at the same chart. It's actually still same chart. Now, this is the first. Okay. Now, this is the first mitigation. Price pull into that area. Okay. Still the same chart we have been from the former page. It is still the same chart. Okay. Now, this is the first this is the first mitigation, and price did what? Simply just plummeted again to the downside. And again, price came into that zone one more time, you know, came into that zone one more time to mitigate it, to mitigate that particular zone for the second time. And again, the price what? Simply just went down. So it means that from this same zone, we could have had two different trades. You know, we would have made money on this first move, okay, take our profit, and when price came in again into that particular place, to that particular zone to mitigate it, we can of course have our entries again, and simply just make money one more time from that particular zone. So let's quickly move on. All right, this example is actually from is actually a demand area where we are going to be looking for to buy from. Now you can see from this side of this particular chart, you can see that there are small bodied candles that represent that actually telling you that um, institutions were not in that particular market. They don't have a footprint in all of those. So when we see those, what do you do? We simply just stay out of the market until we saw this particular big move to the upside. It's a big candle to the upside that broke the former structure, that broke the resistance, that broke structure. It simply just break it to the to the upside. So what do? We simply just wait for price to come back to mitigate that particular place. When price came in to mitigate that particular place, what did the price do? Price simply just went back up. Okay, it means that we certainly go in this first pullback. It represents the strongest, okay, the strongest possibility for our buying for buying this particular instrument at this particular point. So price came in and we simply just do, we have to buy whatever it is we have to buy. That is actually the first possibility. All right, the first mitigation represents the first possibility. Okay. All right, so let's quickly just move on. Now look at this again. Look at this. Now you can see that A represents the resistance. Okay, it represents the resistance where price got to and began to plummet to the downside. Now there was this doji candle before this big move to the upside. Now the big move was big enough to break the former resistance to at this particular point, and it was body break. It was strong to the upside, right? Okay. Now once we saw that that particular resistance was broken, then we're going to locate that small candle, the small bodied candle, the candle that had that very activity in it before the big move actually began. Okay, so now we saw that there is a big movement. Then number two, there is a break of structure. Then number three, we discover that that zone is still what, is still very fresh. Okay, this is the first time the price is actually coming into that particular place to what, to simply mitigate it, and we were able to see, we were able to have an opportunity in that particular place to what, to buy, and we join. You look at what happened next. The price simply just rally to the upside. All right. Okay, so let's quickly continue. All right. Now look at this freshness of the zone again. There is a demand zone around this particular place. A big move that broke this particular resistance in this place. Now this is the first time that the price that place came that was mitigated. Yeah, this is the first time, and of course we saw that. So it means that this first time is still what, is still fresh. This is the second time. Look at the third pullback. Price simply just pulled, just broke through that particular place. That zone failed on the third attempt. All right. Okay, so quickly let's take these notes. Please take this as a rule. The first and second pullback can be traded. In other words, the first and second mitigations can be traded if there is a clear price action signal. Those things that we're still going to talk about when we get to entry protocols. However, the third pullback to the supply and demand zones should be what, should be ignored. Ignore it if it is more, if it has been mitigated, if it has been tested, if there are pullbacks into that zone for more than two times, just ignore it. So this is going to be the end of this particular model. I'm going to see you in the next.